So we move on to part two now for chapter 13, non-bank finance. So I'm picking up where we left off. And, screening, we talked about screening, and all candidates for insurance get screened. And basically, depending on your risk, your assigned pool or risk level, that'll determine your premium. And you people all know when you have car insurance or you have $500 deductible or $1,000 deductible. And co-insurance means when you have a medical insurance, let's say you pay 20% and the company pays 80%. That's to prevent, moral hazard. Okay. And of course, limits on the amount. If you try to put $1 million on a rusty bucket car, obviously they're not going of insurance. They're not going to give that to you, right? So these are some of the terms that are important with regard to that, and they're all described in detail in your textbook. All right, so now we move on to pension funds here, and there's a couple different types, and I'll highlight these here. Right, there's defined contribution, and there's defined benefit, and the simple difference between them, as I may have mentioned before, is defined contribution is like a 401k, right? And that's what most of us have now. A lot of companies can't afford it no more, and they moved away from a defined benefit. Defined benefit was a fully funded pension plan where you got paid without having to put anything in. And I think the New York State retirement system and the school teachers have that. And so basically, that's the major difference here, right? You didn't have to really, contribute that much, and you got a full benefit as opposed to a 401k here. All right, and then there's private pension plans too, right? So private pensions are covered under the ERISA Act of 1974. Okay, so that's basically how private pensions are done. Public pensions are done on again, like the New York State system. Okay, so there's two different types here. So here's the public pension plan, and of course, the big one is, as you know, is Social Security. And Social Security's always got problems, always going broke, right? They're always complaining and they're always going broke. Okay, and so it's a pay-as-you-go system, right? As you go on in the years, you get paid, you pay in, and then when you retire, hopefully when you retire and you don't die, you will start collecting on it. And usually you get your full benefit at a certain date and time. Okay, and I think at 70 is when you get the maximum benefit at age 70. But as you know, or may not know, it's really underfunded and it's really going broke all the time. And they're always talking about reforming Social Security. On page of 303 in your book, there's a nice FYI for your information on Social Security, and it's called Should Social Security Be Privatized? Okay, so it's a good read, and it's worth reading, and then they'll tell you as at one point there was a massive underfunding of $1 trillion for the Social Security system, $1 trillion, but we're going to be in bigger problems now with the coronavirus, with the economy crashing. Okay, so here's that whole thing. So should Social Security be privatized? So government investment of trust fund assets in corporate securities. So there's three basic forms that they're looking at for privatization, which most likely are not going to happen, all right? Shift of trust fund assets to individual accounts that can be invested in private assets. I don't think people should be allowed to touch this money, and I think it's best left in the government's hands, even though they're not the best. And so there's all these different methods, and your book describes each one. And for the most part, if you're going to ask me, nobody should touch Social Security. The public wouldn't know what to do with it. They'd blow it too quick. They'd blow it too quick. Okay, so then there's finance companies, and what these basically are kind of like unregulated companies that loan you money, such as household finance and beneficial finance. And if you can't get a loan, you'll go to these companies and they'll loan you money, but at a huge, huge interest rate. Okay, and they're consumer finance companies, right? And even credit cards are considered finance companies. So they're pretty much on their own, and they. So as far as these sales finance companies go, two of the big ones that are listed in your book, right? You can see there's Sears had one. Now I don't know if Sears is going to have one anymore, and General Motors basically had one. When you lease their cars and stuff, so that's what these are. And business finance companies are companies that will buy your accounts receivable. They're called factoring. They'll buy your accounts receivable, and they'll also lease equipment, to you. All right. So security market operations, and they are basically called financial facilitators, right? And let's see if I can highlight that. And financial facilitators are investment banks. Now, an investment bank will be an intermediary between a company issuing stocks and bonds and the public. And the investment bank's job is to get that stocks and bonds sold, and they make money on the spread. They'll make their profit on that. Okay, and then there's security brokers and dealers when you buy stocks and bonds on organized financial exchanges. Right, here you go, such as the New York Stock Exchange or NASDAQ up on 42nd Street there. Now, NASDAQ doesn't have a trading floor. It's all computer operated, right? So you have security brokers and dealers, and you have organized exchanges. All right, so basically what investment banks do is they'll assist in the sale of securities, and they'll advise the corporation on whether it should issue the bonds or stock. They do all the research, right? So they're going to do all the research. So bonds, they advise on maturity and interest payments, and stocks, they'll advise on what price to set and whether or not they'll be able to get so many shares sold, the quantity, and they'll underwrite it, and they'll basically give the money right to the company, and they'll bear all the risk. This means they bear all the risk of getting rid of the shares. All right, so investment banks are regulated by the Securities and Exchange Commission, and so are the stock exchanges. And everyone always, if you're going to buy stocks or bonds, you must get a prospectus before you buy anything, so you can read on what you're buying. So a prospectus is very important to always have. So let's highlight that, all right? You should always get a prospectus. All right, so here's some of the organized exchanges, as I mentioned. Here is the New York Stock Exchange on Broad and Wall Street down there. And as you know, they were trading electronically during this whole coronavirus. And basically, is NASDAQ, and they were created, they're regulated by the SEC, Securities and Exchange Commission, who sets the rules and alters the rules by the exchanges. And obviously, organized exchanges have now gone international, right? Globalization there's organized financial exchanges all over the world, right? All right, so mutual funds are a great source to put money in if you don't want to deal in individual stocks and you want to just spread diversify your risk, because mutual funds have hundreds and hundreds of different stocks in them or bonds. There's probably thousands of different types of mutual fund. And the most important thing here is what they say is they pool the resources of many small investors by selling shares and using the proceeds to buy securities, right? So there's a couple different types, open-end and closed-end funds here. Highlight that, and let me save that. So as far as an open-end fund is the one we're most familiar with, right? We can buy shares in and redeem them anytime we want. And a closed-end fund is almost like a private mutual fund where they buy shares and then they're sold like stocks. Okay, so there's two different types. And then there's loaded funds and no loaded funds. Okay, and basically most mutual funds are pretty much currently no load funds. They're sold directly to the public with no sales commissions, right? So they just they only collect management fees, and again they're regulated by the Securities and Exchange Commission. And there's money market mutual funds, and they're basically checkable deposits. They earn interest on you earn interest on these mutual funds. All right, hedge funds are for big time investors who have millions to invest, such as Renaissance Technologies. They're up in Stony Brook, run by Jim Simons. And you can see typically that in some of these, the minimum is usually 10 million. And they'll have no more than 99 investors. And there's a lot of rules with these, and there's a lot of risk associated with these too. You can see the requirement for investors is a certain minimum net worth. So this is not really for little guys like us. All right, private equity and venture capital. If someone's going to start a company and needs money, this is where you go. And basically, I mean, like Amazon and Facebook, this is how they got started, with private equity funds. Okay, and they set them up and they invested, and private equity makes sure they get their share of the pie. And you can see they're not traded in public markets here, right? They're not traded in public markets. So this is basically the for companies that like .coms that are just starting up, or any new type of company. All right, and then there's mortgage markets. So there's a lot of different government agencies here with different names and acronyms. And you could basically read up on those. And there's a whole lot of reading you could do on the global financial crisis. I think in your book there was a whole section on the global financial crisis here. Right, page 312. That is definitely worth reading, and you should get some good videos out on the global financial crisis. All right, so that's pretty much it for next time. Tomorrow I will make a video for chapter, I believe it's 14, and we'll talk about financial derivatives. All right, so chapter 14 will come next.